Well, Wall Street expects the Fed to announce Operation Twist this afternoon. Our next guest agrees. He's Carl Lantz, Credit Suisse's head of interest rate strategy and also a former Fed economist. Carl, glad to have you on the program. So you expect Operation Twist. What is going to be the immediate impact if we do see that?
Yeah, it's cloudy with the chance of a twister today, right? So
I haven't heard that yet. I like that.
Yeah, I'm sick of the dance analogies. So we do expect an Operation Twist today. I think it's pretty well priced into the market. We think it should be around $360 billion. That plus extending the maturity of the reinvestments will make this almost as big as QE2 in terms of the duration that's taken out of the market each month. The reaction should be a bit of a rally in rates. You know, it's pretty well expected, but there's always that chance the Fed might not act, and I think traders will be relieved when the Fed does come through at 215. I think more interesting might be what happens on the equity side. This is a little bit different than the QE1 and QE2, where the Fed was actually increasing the balance sheet and quote unquote printing money. That I think that became a sort of rallying cry for the reflation trade, for commodities, for gold, and for equities.
Right, this is not happening right now.
No, that's not what's on the table now. This is a bit more technical almost, with the Fed just shifting its portfolio further out. It's good for the interest rate market. And you could argue that getting rates a little bit lower is going to help the economy on the margin, but it's really not rates that are constraining the economy right now. You know, if this can get banks to ease credit conditions a little bit, sure, that would help, but this is no silver bullet.
But do you think it will?
Well, again, you know, I think it doesn't hurt. It's certainly you know, a little better on the margin, but I don't think we'll have a material impact on sort of measurable GDP or unemployment. The best case for this is that it provides a boost to sentiment, which certainly happened with QE2 and QE1. It does feel like this time is a bit different in the sense that we still have this overhang from Europe. Back when QE1 and QE2 were announced, the economy was actually starting to turn up from low levels.
Yes.
And right after QE2, you got the big fiscal stimulus with the $112 billion Obama payroll tax cut. Now the Republicans are looking to block the extension of that. So we're sort of in a different world right now.
So you mentioned the equity markets, that you take the cue from the equity markets. What are you looking for then? Or, you know, if equities rally, what's likely going to happen then?
Yeah, I mean, if equities rally, it could be significant, and they're sort of right up against some resistance levels in the S&P, and people would look at this as breaking out of the range, and maybe the uncertainty is out of the way with the Fed announcement, and that would clear the way for higher prices. And I think then you would see the bond market retrace and come back to, you know, 210, even up to maybe 225 in tens. I do think it may be more likely, though, that in equities it's a bit more sell the news. And the disappointing thing after this is, you know, at 215, we're probably going to get the Operation Twist and a small cut in the interest rate on reserves. That's essentially the last two tools the Fed has right now. I think they're very constrained in terms of growing this balance sheet anymore. You've seen the political pushback just in the form of the letter yesterday.
Well, Carl, that's a good point, because you say sentiment. I mean, I wonder if sentiment will then, you know, be focused on the fact that the Fed may no longer have any more tools left, and then what do you do after that?
Right. Yes, I think this will focus people on the fact that, you know, this policy is very incremental and it's about all the Fed has left to do. And then you turn to fiscal policy and you realize it's very unlikely the sides will come together there. And then you look internationally, and of course you've got problems in Europe. So, you know, for equities, it probably will depend a lot on how earnings shake out as we get those next month. You know, whether or not companies are actually seeing the downturn we're seeing in some of the economic numbers coming through from August and September.
Okay, Carl, thank you. Appreciate it. Carl Lantz of Credit Suisse.